We're updating our everything you need to know about the SBA loan program to buy a business guide for 2025. We're going to cover everything. We're going to cover net worth requirements, credit requirements, work experience, interest rates, down payments, licensing, real estate, debt service coverage ratios, all of it. So hit the save button because you're going to want to come back. First, when people say SBA loans, they're talking about loans backed by the Small Business Administration. You get these loans from a bank, not from the government. The government provides a guarantee to the bank, so making them more willing to lend to you. So you go to your local bank or work with a lender, or you could work with us to get the SBA loan. There are different types of SBA loans, but the most common is the SBA 7A program. Through this program, you get up to $5 million to buy your own small business, and you can pay it back over 10 years using the cash flow from that business. And they even made a recent update to the program where you can actually borrow more than $5 million, but you have to buy a business within a different industry of your current business. So for example, you could buy a $5 million HVAC company, and then you could go buy a $5 million fire suppression company. Now these limits apply to both the individual and the entity. So if you have two partners going in on one business, the max is still $5 million. If you have a husband and wife within your house and you want to buy within one industry, you're still limited to $5 million. Now, one big misconception is that you need to have a lot of personal assets or personal collateral to take out one of these loans. Now, that's not true. There are some banks that might require this. The standard operating procedures of the SBA actually say they're not supposed to. But the good news is that even though there are some banks that require you to have a lot of personal collateral, there are plenty of banks that don't. Need one of those, let us know. We do deals all the time where the buyer has very little to no personal collateral. You're also going to receive the cash that you need to run the business through this process. So you don't need to come with a lot of cash on hand to run the business. Now, the business you buy is probably going to require some amount of working capital or cash to run the business, but you can get that as a part of the SBA loan. So typically you can get up to $500,000 in working capital or cash to run the business. So if you wanted to cap the program out, say you buy a $4.5 million business and you get $500,000 of cash, so you're going to start with $500,000 in the bank day one. But a lot of businesses do need more than $500,000, and it is possible to get $500,000 in cash, but it's less likely. What you do is you just work that into the purchase agreement. So if you need $1 million, you get $500,000 through the SBA 7A program, and you get another $500,000 from the seller. You tell the seller that they're going to leave some cash in the business, and you work that into the price, and it's all part of the negotiation. So that way you can come up with $1 million of cash in the bank, even though you came to the table with much less than that. So the only cash you really need to bring is your down payment. So technically for the SBA program, the down payment requirement is 10% of the total project costs, but you can reduce that by getting a seller note from the seller that's on 24-month standby that can count towards your down payment, or if the seller maintains a portion of their equity. So say you only buy 90% of the business and they keep 10. If you do that, then the down payment requirement or equity injection has been met. Now, most banks are not going to allow you to come and buy a business with zero down. They will allow that if you're buying a business that you already work for, but unless you already work for that business, then you should expect to bring some cash to the table. So now it's typically 2.5% if you have strong industry experience, management experience, and sales experience. And most other deals can get done around 5%. Now, the good news is legal fees and other expenses that you realize as a part of the process can count as your down payment. So let's say, for example, you spend $30 in legal fees to complete a deal, and the down payment requirement at 2.5% is $30,000. All you do is prove to the bank that you paid those legal fees along the way, and that will count as your equity injection or down payment. One key there, though, is you can't put those payments on a credit card. So make sure you use a debit card or pay cash. Now, new for 2025, they've loosened up some rules around partial buyouts. Before, there were some issues, technical issues that made partial buyouts very difficult. And even not that long ago, they weren't allowed at all. But 2025 is going to be the first year that you'll really be able to truly do a partial buyout. So that's where you're buying 90% of the business or 80% instead of 100%. Now, this typically comes into play if there's a licensing requirement. So if you're buying an HVAC company, you need to operate off of the seller's HVAC license for a while you get yours. Then you probably want to do a partial buyout rather than a full buyout. So the new rules make that a lot easier. Just make sure that you're going to need to keep the seller's ownership below 20%, or else they're going to have to be on the personal guarantee for the loan. So anyone that owns more than 20% of an SBA loan is part of that personal guarantee. Now, you don't need perfect credit to qualify for the program. Typically, a 680 or better is all you need. Unfortunately, if you have an 800, you're probably going to get the same terms as someone that has a 680. And you can even qualify if you have less than 680, but everything else about the deal needs to be really strong. So we did one not long ago where someone had a credit score really only a little above 600, but they were already running the company. They've been managing the business for 10 years. So the bank was able to overlook some of the credit issues, and they also understood the reason why the credit score was low. So it is possible with a lower credit score, but generally you want to have over 680. Now, in most instances, the interest rate is variable. Typically, you're going to pay between 2 to 3% above what is the Wall Street Journal prime rate. You can look today, just Google Wall Street Journal prime rate to see what the interest rate is today as you're watching this video. To be safe, I always like to look at the highest possible number. So the most you could pay is 3% over that rate. So whatever shows up when you do that Google search, add 3% to it. That's what you should expect your interest rate to be. Now, SBA loans can be used to buy owner-occupied real estate with as little as 0% down. And the terms on the real estate purchase are 25 years versus the 10 years used to buy a business. Now, one key factor is that the SBA loan program is for buying businesses, not real estate. So this means you can generally not buy things like apartments or single-family homes or office buildings unless you're going to occupy more than 51% of that office building. And that can also apply to, say, a retail property or a strip mall. So if your business occupies over 51% of the property, then you can use the SBA loan to buy real estate. And they do actually count hotels and storage units as businesses. So you can typically use an SBA loan to buy a hotel or a storage facility just because they consider that an operating business and the real estate is just part of operating that business. Now, one of the biggest factors for getting approved for your SBA loan is going to be your work experience. How well do you fit into this business? Does it fit your industry background? Does it fit your management experience? Does it fit your sales experience? Because typically one of the main reasons why SBA loans default is because someone who didn't have good experience went and bought that business. Now, if you don't have industry experience, then you're going to need a partner. Typically, you want someone that has 10, 15% equity ownership in the business that can qualify for things like the license or bring the industry experience. And that's one way that you can qualify for the loan, is that you're essentially using someone else's industry experience. But this can be tough. I wouldn't expect to be able to just plop an operator out of thin air like a lot of people think you can. If you already know someone, it's probably good to work with them to try to partner. It's often can be good to give equity to someone who's already in the business. We've done that before. It's worked out very well. But partnerships can be tricky. Now, one of the most important factors in whether your loan's going to get improved is the debt service coverage ratio, or DSCR. Now, this is a measure of the business's ability to make the loan payments. So typically, banks are going to want to see a DSCR over 1.25, meaning that the business generates 125% of the cash required to make that debt payment. We have a great free tool on our website so that you can run your deals through and figure out where your DSCR might fall. Just go to owneractions.com/DSCR. It's free out there. Use it. Now, when trying to figure out what your DSCR is, the two most difficult inputs are going to be your required salary and the CapEx of the business. Now, your personal expenses is the minimum salary that you can receive to make just your general personal expenses. So think your rent, your mortgage, your car payments, your student loans, any debt that you have. So they're going to look at what you have to take home, and they're going to take that into account in that DSCR. So what they're going to do is they're going to take your monthly payments, your monthly debt service, and they're going to divide it by 0.4 and then multiply it by 12 to get an annual number. And they're going to subtract that from the cash flow from the business to determine how much cash is left to make the debt payment. CapEx can also be difficult. That's the amount you need to spend every year just to keep the business running. You can start with just an educated guess. Throughout the process, ask the seller. So if you have something with very heavy equipment, like an equipment rental company, you should expect a very high CapEx number, or a trucking company. If you have just a service business that doesn't have any vehicles or trucks or anything like that, your CapEx can be very low. You can get a clue by looking at the historical depreciation of the business. So it should be, if you average out the years of depreciation, it should give you an idea of what the annual CapEx spend is. Now, lastly, pre-approvals. Now, pre-approvals don't mean that much because ultimately the approval for the loan is really going to come down to more to the business than just you personally. And most people qualify for these SBA loans. But it does show that you're a serious buyer if you get a pre-approval. Sometimes you can get past a difficult broker if you have a pre-approval. Sometimes brokers think that you need to bring 30% down or something ridiculous like that when really you only need 2.5%. So if you come with a pre-approval letter that says that you can get a bank loan for the amount of this purchase, that can really help you. Now you can get a pre-approval from your bank or whoever you're working with. We can also help you get one. So if you need a pre-approval, reach out to us and we can help. Now the downside is that on any SBA loan, they are gonna require a personal guarantee, and per SBA rules, they have to collateralize to the extent possible. So what that means is that if you have no physical assets or anything that they can collateralize, they're gonna collateralize nothing. If you have a huge multi-million-dollar real estate portfolio with no debt against it, they're going to collateralize that portfolio, which means that if you were to default on the loan, it means that those assets could be seized by the bank. Now, the good news is the SBA is also pretty good at working with borrowers when they get in trouble. So if you ever do get in trouble with an SBA loan, reach out as soon as you can and try to work with your lender. But you should never go into taking out an SBA loan without thinking about the risks of that personal guarantee. Now, if you think you found a deal that's ready for financing, click the link in our bio and we can help you find a lender for free.